we're looking at one of the most defining and honestly most devastating economic events in modern history, a moment when the entire global financial system just ground to a halt. It literally brought the world to the edge of total collapse. So in this explainer, we're doing a deep dive into the anatomy of the worst financial disaster since the Great Depression, the 2008 financial crisis. We're going to break down exactly how it happened, who was pulling the strings, and ultimately what it cost all of us. And to really wrap our heads around the sheer scale of this disaster, we have to look at the immediate destruction of wealth. From its peak in the spring of 2007 to the start of 2009, an unfathomable $11 trillion in U.S. household wealth essentially vanished. Poof, 11 trillion. To put that into perspective, that isn't just a number blinking on some Wall Street spreadsheet. That's life savings, it's college funds, it's pensions, it's the financial security of an entire generation, completely wiped out in a matter of months. And naturally, the human toll here was just staggering. Because this crisis didn't stay contained to Wall Street. It cascaded right down to Main Street. In the U.S. alone, an estimated 8.7 million jobs were lost. It triggered what we now call the Great Recession. This was a brutal global economic contraction that shattered communities, shuttered businesses, and forced millions of families into foreclosure. But, to really understand how things got this bad, we have to go back to the beginning.
Part 1. The setup. Building the house of cards.
You see, the 2008 crisis wasn't some sudden, unpredictable storm that caught everyone off guard. It was years in the making. The foundation was really laid through a series of structural shifts. Back in the 1990s, the U.S. government made a massive push to expand affordable home ownership, which naturally encouraged looser financing rules. Then in 1999, Congress partially repealed the Glass-Steagall Act. That was a Depression-era law specifically designed to keep safe, boring, traditional banking completely separate from high-risk investment banking. Fast forward to the early 2000s, and the Federal Reserve drastically lowers interest rates. Suddenly, borrowing money was incredibly cheap.
And that flood of cheap credit gave rise to what became a literal weapon of mass financial destruction, the subprime mortgage. Now, by definition, these were high-risk loans granted to borrowers who had really poor credit histories. Lenders would entice people in with these adjustable-rate mortgages that offered a seemingly super affordable, very low initial interest rate. But there was a massive catch. After a few years, those rates would reset and suddenly spike, dramatically driving up the borrower's monthly payment.
Part 2. The greed, the shadow banking boom. So with interest rates on the floor and housing prices climbing, Wall Street and these mortgage lenders saw a golden opportunity to make some mind-boggling profits. They built up this massive shadow banking system that operated almost entirely in the dark, with very little regulatory oversight. Traditional underwriting standards completely thrown out the window. In this frantic race to approve as many loans as humanly possible, lenders engaged in wildly reckless practices. We're talking predatory tactics targeting low-income borrowers, 0% down payments, and completely ignoring the massive red flags of terrible credit ratings. And why would they do this? Well, because the mortgage originators had zero intention of keeping these loans. They were selling them off the second the ink dried. They sold them straight to Wall Street. And Wall Street took these loans and turned them into mortgage-backed securities, or MBS. Here's how it worked. Financial engineers would take thousands of these highly toxic individual subprime mortgages and bundle them all together into one giant financial product. Then, the credit rating agencies slapped their absolute highest, safest ratings on these bundles, completely masking the radioactive risk hidden inside. Armed with that AAA rating, Wall Street turned around and sold shares of these supposedly safe securities to investors all over the globe. Now, this whole process created a fatal blurring of lines. Because of that Glass-Steagall repeal we mentioned earlier, traditional depository banking, the guys who handle your everyday checking account and safe auto loans, merged with investment banking, the guys doing high-risk proprietary trading and complex derivatives. So the boring, safe money was suddenly being gambled in the high-stakes casino of mortgage-backed securities. Fueled by all these easy loans and cash-out refinancings, the housing bubble just rapidly inflated. Look at this. U.S. home mortgage debt relative to GDP averaged around 46% during the 1990s. By 2008, it had exploded to a staggering 73%. The entire U.S. economy was essentially running on borrowed money, all tied to a housing market that people falsely believed could only ever go up.
Part 3. The collapse. The domino effect.
But of course, the housing market couldn't go up forever.
Between 2004 and 2006, the Federal Reserve started raising interest rates. The era of cheap money ended, and the dominoes started to fall. The mechanics of this crash were just incredibly swift and brutal. Step 1. As interest rates went up, those adjustable rate mortgages we talked about reset to much higher payments. Millions of subprime borrowers suddenly couldn't afford their homes, and defaults skyrocketed. Housing prices nosedived. Step 2. Because the underlying mortgages were failing, those mortgage-backed securities instantly plummeted in value. Step 3. Banks looked around and realized the assets on their balance sheets were absolutely toxic. And because nobody knew who owed what or who was secretly on the verge of bankruptcy, banks just flat out stopped lending to each other. The global credit markets froze in a state of sheer panic. What followed was essentially an institutional slaughter, playing out over just a few months in 2008. In March, Bear Stearns, the fifth largest investment bank in the country, was essentially forced into a fire sale to J.P. Morgan Chase. Come September 7th, the government had to step in and seize Fannie Mae and Freddie Mac, the giant government-sponsored mortgage companies. And then came the absolute climax, September 15th, 2008. The prestigious investment bank Lehman Brothers files for bankruptcy. When Lehman folded, they were holding a record-breaking $613 billion in debt. Let that sink in. $613 billion. To this day, it remains the largest bankruptcy filing in U.S. history. When Lehman fell, global markets immediately went into a tailspin. It triggered a massive stock market crash and literal bank runs across several different countries. The system wasn't just cracking anymore. It was in free fall. The panic reached the absolute highest levels of government. Just 3 days after Lehman went down, Federal Reserve Chair Ben Bernanke met with congressional leaders to urge an emergency bailout. And he delivered this chilling warning. If we don't do this, we may not have an economy on Monday. I mean, think about that. The global financial system was literally days away from total vaporization. Part 4. The aftermath. Wall Street versus Main Street. While the government was scrambling to put out this raging fire at the very top of the financial system, the blaze was really just starting to tear through Main Street. And the contrast here between the institutional rescues and the everyday public suffering is profound. This economic shockwave completely doubled the U.S. unemployment rate, taking it from a relatively healthy 5% in 2007 to a peak of 10% by October 2009. The average hours per work week dropped to the lowest level since the government even started tracking that data in 1964. Poverty rates spiked. People weren't just losing their houses, they were losing their entire livelihoods. And the destruction of wealth was just absolute. The Dow Jones fell by 53% between October 2007 and March 2009. Some estimates actually suggest that 1 in 4 U.S. households lost 75% or more of their net worth. All told, this crisis drained up to $4.2 trillion of wealth directly from consumers. Meanwhile, to stop the bleeding over in the financial sector, Congress authorized TARP, the Troubled Asset Relief Program. This was a massive $700 billion fund designed to buy up those toxic mortgages and inject capital into failing banks. So the public had to stand by and watch as the exact same institutions that recklessly drove the global economy off a cliff were rescued by taxpayer money, while average citizens were stuck standing in job lines and facing foreclosure.
Part 5. The lesson for today. Are we safer now?
Following the fallouts, there was this massive global push to make absolutely sure a collapse of this magnitude could never, ever happen again. Regulators moved fast. Here in the U.S., they passed the 2010 Dodd-Frank Act, basically overhauling financial regulations to strictly limit the kind of risks banks could take. On a global scale, we saw the Basel III standards, which legally forced banks to hold much larger cash cushions to absorb potential losses. And consumer regulators stepped up big time, keeping a much closer eye on mortgage and credit card lenders to stamp out those predatory practices that sparked the whole mess. But as they say, memories in finance are often pretty short. By 2018, a new piece of legislation, the Economic Growth, Regulatory Relief, and Consumer Protection Act, was signed into law. And objectively speaking, this act rolled back and weakened certain parts of those post-crisis Dodd-Frank guardrails. The goal was to ease oversight on mid-sized banks to promote economic growth. Which really leaves us with a pretty critical, lingering question. Have we truly fixed the underlying fragility of our financial system, or have we simply delayed the next inevitable collapse? Because the 2008 crisis showed us exactly how dangerously interconnected global banking becomes when greed outpaces regulation. The anatomy of this disaster is a blueprint we absolutely must remember, because the cost of forgetting is just way too high.